Well, March was all about banks and bank failures. Silicon Valley Bank, Signature Bank, First Republic Bank, Credit Suisse, and more. So, I figured that this is a perfect time for some bank jokes. So, for instance, what's the hardest part about being addicted to banking? The withdrawals. Okay, here's another one for you. I quit my job at the bank today. I guess you could say I lost interest. All right, enough of that. This is Steve Wolf, and it's time for my review of what happened in the month of March. First, I want to apologize for the lateness of this review. March has been over for 11 days as of today's podcast shooting, and a lot of things have happened. But for those of you who know me, you know that I'm a basketball, especially college basketball junkie. So I have been glued to the TV for the last month and a half, watching the NCAA tournament, March Madness in all of its glory. But this year was especially great because I live in the San Diego area, and one of the teams in the tournament was San Diego State University, and they made it all the way to the finals before, unfortunately, they succumbed to the University of Connecticut. But as soon as we found out that they were going to be in the Final Four in Houston, my wife and I said, we've got to go. This has always been on my bucket list forever, to go to a Final Four. So we went to the Final Four, and that's why I'm a little bit late in doing this. So anyway, let's talk about what happened in March, keeping in mind that what I'm about to say is strictly for informational purposes only and is not meant to be a recommendation. Before you buy or sell anything related to anything I'm saying about the markets or individual securities, be sure to consult your financial advisor to ensure it's the best recommendation for your personal situation. So let's start with the Silicon Valley Bank. This was a classic case of a bank mismanaged, and I believe inadequate supervision also of the bank. Everyone on the planet knew that interest rates were going up. The Federal Reserve said they were going to do that to fight inflation. When it went from 0 to 1%, you knew 1 to 2%, 3 to 4%, etc. So the bank should have realized what was going on, but for some unknown reason, Silicon Valley Bank didn't do that. And as many of you know from my past videos, when interest rates rise, the price of a bond goes down. And as some of you might know, a bank needs to balance the amount of money it needs for depositors and the amount of money it can invest for the long term to make money for the bank. Well, there was an enormous miscalculation by Silicon Valley Bank, as it took in way too much of its cash, consisting of way too much in uninsured deposits, and invested in longer U.S. Treasury bonds and federally backed mortgage securities. Now, there's nothing risky really about a long-term U.S. Treasury or a federally backed mortgage security. So from the standpoint of credit risk, Silicon Valley was okay. The problem was it wasn't credit risk that was the problem, it's interest rate risk. And that's what they didn't account for. So as interest rates went up, all of these longer-term securities went down in value. So if depositors wanted to get their money, the only way the bank could do that is to sell securities at a loss. Well, the bank tried to raise, and by the way, that's precisely what happened to Silicon Valley Bank. They tried to raise money, $2 billion in capital to cover, but it was unable to do so, according to CNBC's David Faber. He said that Silicon Valley Bank was looking to sell $1.25 billion in common stock and another $500 million of convertible preferred shares, but unfortunately they couldn't do that. Well, many of Silicon Valley Bank's depositors were startup technology companies, and these companies needed their money for everyday management, like making payroll, paying bills, things like that. So when word got out that Silicon Valley Bank was trying to raise capital, it really created a classic run on a bank. Now, the reason I say that it's not just Silicon Valley Bank's mismanagement, but also that of the government, is that Silicon Valley Bank had been warned by the government 3 or 4 times over the previous year that they had this problem. And yet they did nothing to solve the problem either. So yes, mismanagement by the bank was the main reason, but I think some mismanagement by the government also didn't help. At any rate, so it created this classic run on a bank. And as you know, if everybody tries to get their money out of a bank at the same time, you can't do it. The cash isn't there. Anybody who's ever watched It's a Wonderful Life with Jimmy Stewart would know this. At the time, you may remember that there was a run on the banks, and his customers came to the window and demanded their money. And he said, June, it's not here. Sally, Jim, Ralph, it's not. The money isn't here. It's in your home, and your home, and your. It's in all the different homes. It's invested. So the money is not at the bank. But when there is a run on a bank, that's exactly what happens, is that they don't have enough cash. So Silicon Valley Bank was taken over, and in this particular case, the government decided that they were going to protect a lot of the customers of the bank by protecting them from more than the $250,000 limit that the government had set. So nobody at Silicon Valley Bank seemed to have lost any money, but I think the moral value on that is something we can discuss. In the meantime, other depositors at other smaller regional banks got extremely concerned that their bank was going to do the same thing that Silicon Valley Bank's bank did, and started taking cash out of those banks. Much of the cash went out of the regional banks into the big banks, but certainly there were some regional banks that suffered. Eventually, the furor over all this died down, as it has become obvious that this was not a systemic issue. However, the damage had already been done to the stock price of many of the regional banks. Now, there was also a problem for Credit Suisse. Now, Credit Suisse is one of the bigger banks who's headquartered in Zurich, Switzerland. And according to Investopedia, they faced numerous scandals over the last few years, including a spying scandal, the collapse of 2 investment funds in which they were heavily involved, and a rotating group of executives. When this banking problem surfaced, the shares tumbled and the bank was eventually bought out by their rival UBS. So with all this going on, what happened to the stock market in March? Well, unbelievably, the Standard & Poor's index was up by about 3.5%. The Dow Jones Industrial Average was up by about 1.9%. And the NASDAQ was up about 9.5%. That's a pretty big gain in 1 month. And according to the chart on the Schwab Advisor Center, where it really hurt was the S&P Regional Banking Index, which was down about 29% in March. But again, it appears to have stabilized here over the past 3 weeks or so. So I looked at the CNN Business Fear and Greed Indicator this morning, April 11th, as we have shown you here in the past. And interestingly, with all that has happened in March, the Fear and Greed Indicator is actually showing that we're at a 61 rating. And that means that we are firmly in the greed category. Now, you would think that there would be more fear out there, but apparently not. So, with the markets up for the year and people back in the greed zone, what do you think will happen for the rest of the year? Well, in my opinion, the Fed might raise one more time, maybe 25 basis points. But what the regional bank scare has done is tighten credit. I was watching CNBC, and they were talking about how people can't get loans right now. And, of course, that's what happens when credit is tightened. Now, this should, and probably will, slow down the economy and probably have the same effect of raising interest rates. So it's possible the Fed is almost done raising rates. Maybe they do this, like I said, one more time at 0.25%. Of course, no one knows for sure, and anything can happen, so do your own homework or consult with your financial advisor before making any moves. And the overall stock market, just remember that the overall stock market on the basis of price to earnings is not cheap at the moment. So just be careful in what you're buying, and it's never a bad idea to buy quality. Well, before we end this, I have one quick story to tell you. My uncle always told me he had a fortune in a safe deposit box. He left me the key in his will. I went to the bank. I was really excited, kind of trembling a little bit. I got access to the box and took it into the private viewing room. I opened the box and looked in, and there was an envelope. I opened the envelope, and inside it was a folded piece of paper that fell out. I read it, and it said, "Good things are ahead for you. Your lucky numbers are 6, 10, and 13. Not exactly the fortune I was hoping for. But anyway, one thing I know you can bank on is that I'll be here next month to let you know what happened in April. Until then, happy investing, everyone.